Welcome to StockOdds. This is Dave Singh and Rob Friesen with Odds and Ends, another podcast for you to help you prepare for the week ahead. We just want to get our bearings on what the odds say are good trades for the week and help you get aligned with that as well. How are you doing today, Rob?
Good. I think we do it for each other more so than the rest of the community. They can listen if they want, but we got to discuss this stuff because we got to hit the ground running on Monday, and some of that follows through all week as well. So it's good to get our head around some of these themes and decide which groups are favored. And we have the ability to be completely diversified, right? Like we can take, one or two stocks, from every industry if we wanted to. We can, in addition to that, we're running at being market neutral anyway, things like that. So we can kind of take on as much macro exposure as we want, hopefully in our favor. We can reduce that tremendously. We can take industry exposure or reduce it. So it's really amazing all the different components to this business and how much you can do and how it can be so different from another person. It's just amazing to me all the different ways that people make money. Mm-hmm. And yet at the end of the day, there seems to be a few ways that people consistently lose money. So the commonality of losing is more similar, but mm-hmm. the methods and models and strategies that people use to make money is quite diverse.
That's good insight.
Yeah. So anyway, we're hitting earnings season here, and we've got the major banks coming out this week. So this is really interesting. Overall, the aggregate earnings increase for the S&P 500 symbols is supposed to be about 27.6%, according to FactSet, if I got that right. So that means that we are expecting earnings to be pretty robust. Mm-hmm. But, what's included that wouldn't have been forecast before would have probably been the bottlenecks, the supply chain disruptions, the fact that, you could have sold a lot more cars if you would have had chips, or you could have sold a lot more of this or that, or it's so industry, broad. There's so many technology components throughout many industry groups that it's going to be interesting to see what happens here with this earnings season because, everyone's expecting there to be that bigger bump. But, we've had these disruptions. And when you look at the amount of ships that are still sitting, at the ports, trying to get unloaded, there's not enough trucks all the way through the supply chain, right, to the final marketplaces. There's, lack of employees, there's lack of service vehicles. It just goes on and on and on. So it's going to be interesting. I heard that Goldman decreased the growth expectations so they went from 5.7 for this year to 5.6% GDP. And then for next year, 4.4%, they decreased it to 4%. So that's just citing things like, some of these bottlenecks, the Delta variant did kick us back a bit, from what was expected, because that wasn't planned for either. So anyway, over to you.
No, I was just looking at the futures for the week as well and trying to get my bearings there. We've got the 10-year up again, oil up again. We're over $80 a barrel.
Well, the bonds are selling off, but the interest rate is rising, right? So the 10-year interest rate if you're watching something like TLT, that's really referring to the 20-year, right? Mm-hmm. So, but if we look at the 2-year, 5-year, 10-year, and 30-year, there's a lot of kind of air pocket coming up here. Like if there's kind of one one support level that I see these bonds are sitting at. The 30-year isn't quite there yet, but
Mhm.
but you notice the 10 and the 5 and the 2 are on that level. If that breaks, there's a lot of air under there, which means that there's room for the interest rates to rise as the bonds sell off. And this could very well be happening, here shortly. I mean, I don't look at a lot of stock charts, like charts on stocks, but when it comes to our predictors, our leading indicators, things like that, we have to look at, what's actually on trend, what's happening. And, I think that bond traders put a lot more work and effort into everything than equities traders, generally speaking, right? There's a lot more stuff they're aware of, and in fact, when we go back to 2020, already in January, when stuff was starting to come out of Wuhan on the coronavirus, the bonds were already reacting significantly to that, whereas the equities didn't really move till more into February, right? And it wasn't until sort of the end of February that things really started rolling down. But the bonds were already factoring things in well ahead of the equities, and I've just seen that they're more research orientated in general, I think.
Mhm. So you see a risk of like a sudden move up in interest rates, and that's going to be very negative for the markets.
Oh, I don't
Yeah.
know if it's necessarily sudden, but just more continued risk to that side, right? I mean, truth be told, I mean, the markets can handle going all the way back to 3.5%. You know, it, but it's because people have been addicted to these low rates, and there are some industry pressures, right? Like there because of the leverage implication and because of the sort of the free money aspect. Um, I think there's going to be that. That's why they call it the taper tantrum, right? It's like
Mhm.
we're going to get upset, but in reality, the markets could handle a lot. You know what I mean? If
Yeah.
people would just take a chill pill, they could handle a lot.
So would you use that to press certain sectors more, like
Oh
continue to
yeah.
longer financials and short utilities, real
Well,
estate?
I mean,
Kind of right.
here's the monkey wrench, right? You got the banks have earnings, which can affect the financial group, right?
Hmm.
But if we're expecting them to be, okay, because they really haven't had the benefit of, the interest rates going back up is when they tend to usually make more money, right?
Hmm.
So the earnings might not be that good, but people will be forward looking, right? So you could have a bad earnings report and the banks would still be up. So I think our downside on that's fairly limited. So the way the 10-year is pointing, the 20-year, 5-year, and the 2-year, I think we can safely, well, safely quote unquote. I mean, we can put our money to work in the financial area still, and take some risk there. So if I had a choice, like in going to StockOdds and curating some odds on financials, I would look more to the long side,
Hmm.
right? So if there was odds that said, hey, short this stock or short that stock, um, I don't have to take those because that's gonna insulate me more and reduce the return on capital because you're long and short in an area where money's flowing into that.
Hmm.
If I'm not sure and we don't have any, information relative to the financials, then yeah, fine. But if we come in tomorrow morning and the 10-year yield, well, wait a minute, bonds are closed tomorrow because of Columbus Day, right?
Yeah, bond market's closed and stock market's open.
So we have a bit of a problem here, right? So when Big Brother is not in the room, you know, the other siblings can run around and cause trouble, right?
That's
So
right.
the futures, the S&P futures and the Dow futures and the Russell futures, they're not going to have Big Brother bonds around to keep them in line tomorrow.
That's true.
So it does change things, right?
So you watch correlations quite a bit, correlations of ETFs to each other, stocks to each other, and you've been noticing that they're getting closer and closer to a correlation of one, right? And in the past, you said that's kind of a risky behavior. Everything just has a correlation of one and goes down, right? It's not as good as one.
Yeah, you'll see more days where, like, if you were to look at the map of the market, that you can see one on FinViz, for example, you're going to see, like, all the sectors mostly green on a day with, there's a few symbols here and there that might be the other way. Or you're going to see all the symbols red. It's like we're getting back to that kind of a market where the entire market moves the same direction.
Yeah.
Right. So correlations of one mean that it's not that high. I'm just saying they're moving in that direction, right? So that more things are correlated. And you do see, like, you could have utilities, up. You could have gold up. You could have technology up. You could have healthcare all up. Like, normally you get a little bit more of a rotation there, right? Like let's sell technology and buy utilities, which are more defensive, right? But they're all up or they're all down. That just tells you something.
Yeah. Well, I was checking the seasonality almanac. We're coming up towards mid-month seasonality on Wednesday and Thursday. That's the 9th and 10th business day of the month. And I wanted to see which sectors are expected to either outperform the spider or underperform. And I found two. The Russell it's expected to do pretty poorly all month, except for mid-month seasonality. It's expected at 1.2% relative to spider's 0.8%. And then also the technology is expected to underperform the spider quite a bit too, 0.54 for the XLK versus 0.81 for the spider. So any insights on how to play that, the Russell, and maybe weakness in tech coming into this week?
Yeah, well, I mean, mid-month seasonality starts on Wednesday. So we've got, we're kind of coming into October's, kind of volatility time. We've already had a little bit already this start of this October, but could be more. So you got earnings, you've got still stuff going on in the government, no, it's like a playground there. You've got this oil problem and well, we'll get into that a little bit later here, but I just saw something that was interesting. Yeah, the mid-month seasonality. Well, I wouldn't get too excited right away, maybe on Monday or Tuesday. Like, things are kind of pointing a little bit softer. With, we have bond markets are closed. We have Canadian markets closed. So there's some volume that's going to be off the table. If you have any dually listed stocks, like some of the banks, some of the railroads, things like that, gold, just be careful that, in trading them, because the Toronto Stock Exchange is closed, where the New York Stock Exchange is open. So it just tends to change their behavior a little bit. The Canadian stocks that are listed on Toronto first, they also listed on New York. So if both markets aren't trading and only one's trading, I just find the behavior different. So just beware of that. Also, if there's less volume on the market in general because of Columbus Day and because of Canadian Thanksgiving, if there's just less volume, it could be either way. It could be, we could have a sell-off that's significant. Nobody's around to provide liquidity and step in. We could have a rally too, just because it's easier to move things when there's light volume. So I would just kind of, if somebody isn't yakking about these things, you just tend to forget, you miss them, right? So we're just yakking about, hey, we're coming into earnings season. We're yakking about seasonality coming into Wednesday, mid-month seasonality starts. We're talking about, Thanksgiving. We're talking about Columbus Day. All of these things add levels of complexity to what we do, and they can be an opportunity, or they can be a risk.
Mm-hmm.
So on that power thing, I was thinking, it's going to be hard to get on this environmental agenda globally when you got places like, India, 70% coal. You got other countries reverting back to using coal because of the energy shortages. There's serious energy shortages globally.
Mm-hmm.
And, they're going to in India, for example, they're going to turn the power off for 4 hours, in rotation here and there and everywhere. And we've seen some of that in the U.S. before too. But, we got some significant energy problems. So we haven't arrived at the time in the future where everything's powered by the sun. We haven't got there yet.
Good. In the almanac, I picked up a couple possible good trades for the week. So healthcare has been down pretty big the last month, minus 6.1%. During the week too, it's the poorest of the sectors. But during mid-month seasonality, it's expected to be a pretty good performer. Things like XLV or even XBI, the biotech, those might be good outperformers come mid-month seasonality. Any thoughts on healthcare?
Well, I like what you're suggesting here, because we have had that discount, and the same argument is for the technology stocks. Some of them have pulled back pretty substantially. So I mean, there could be an argument for technology as well. But when you look at the seasonality, I think that healthcare and biotechs and stuff are supposed to outperform technology for that mid-month seasonality, right? So. Yeah. Then I would definitely be like, if I had a choice and I wanted to be, kind of still mostly diversified, but still concentrate a little bit of capital into some of the better ideas, then yeah, I'd be looking for healthcare stocks that have the best odds of going up and best average performance. I'd focus on the ones that really can give me some bang for my buck, and might still choose a few technology stocks long, but also a few technology shorts, where I might not do any healthcare shorts.
Mm-hmm.
So, this is, again, every trader gets to decide what their exposure is. But I don't think there's anything wrong with combining sort of the seasonality context and then adding the macro, also what's going on. Like normally I wouldn't be suggesting long oil this time of year. Like the normal seasonality doesn't suggest that, right? But we've had a macro disruption, which has kind of overwhelmed that. The only way I can explain this, it's like, an airplane taxiing down the runway. Poor Southwest, sure grounded over 1,000 flights. they're not getting off the ground too well. Poor Southwest. But anyway, a plane taxiing down the runway, and gravity's holding it down. But if it gets up enough speed, then lift takes over, and lifts that plane off the runway and into the air. And it overcomes gravity.
Mm-hmm.
So the way I look at this is macro can influence so many things and knock our seasonality out. So for oil, it knocked the seasonality out. Seasonality was fine in August, but we rolled into September, and towards the end of September, even the last 2 weeks of September, oil started taking charge, right?
Mm-hmm.
And, I'm not going to argue with it. It's got a macro force behind it. And it's also caught a lot of money managers flat-footed. And it's, they just don't have exposure to it. It's a very small percentage of the S&P 500, right? And they just don't have exposure to it.
Yeah.
So we know where the crowded trades are. Everybody seems to be in the same crowded tech stocks for the most part and healthcare. But oil was one of those things that, hey, we got to go ESG. Can't have oil anymore. Can't use that. Nobody needs oil anymore.
Yeah.
Forgetting that even a Tesla has quite a few barrels of oil that probably make all of its parts. Right?
All right. Well, good stuff. Some good ideas.
So as we roll, So I saw, in curating my list, I just saw a lot more shorts initially coming up as really good signals for tomorrow. And I had to downgrade some of my long, qualities to get the long coverage. What did you find?
I haven't run my
You haven't done it yet? Okay. Well, just let me know later if you see the same thing. It's easier to find really good short signals right now, and it's harder to find long signals. Just let me know if that's the case. So I first ran a couple
8-to-1 ratio of longs to shorts. So this is
Well, yeah, that's been the way it's been for so long, right? But it's been changing. I noticed it changing already in September. It's changed a bit in October. I've had a lot of more easy time with shorts. But like running for Monday, it was, like 30% more shorts than longs in terms of great quality stuff that I was looking for. And then so I lowered my standard on some of the longs just to get my long coverage up. Right.
Were you getting just as many symbols from the different signals you monitor, like RSI and percent BB? Do you get more shorts from one signal than others?
No, I did streak scan, I did percent B, I did Connors, and performance, and all of them were consistent in giving me more shorts than long.
It's interesting.
Anyway, let me know what you see. So anyway, we'll hit the ground running tomorrow, and great talking with you.
Sounds good. Good luck. Thanks.